I wanted to talk about SPX and SPY stock today. On Tuesday, we got retail sales, and it reiterated that the economy is slowing down. The pace, and this is important because if the pace slows down, the pace of revenue slows down for companies, and these huge moves we've been seeing in the stock market are probably going to slow down as well. We'll probably see a correction. This is something I've been calling for some time. I've got charts on SPX versus GDP and inflation that when you look at it, it's sort of eye-popping at how rapid the pace is from what we're accustomed to. So retail sales slowing the economy will slow the pace of revenue and SPX overall growth. At the same time, tomorrow, Friday, we get triple witching hour, which is usually a pretty good time if you love volatility. Let's jump in. I'll show you a few charts that I'm looking at and kind of explain why I see the stock market slowing down the pace, and we'll probably see a correction. Let's jump in. Here's a chart on retail sales versus personal income. And of course, retail sales hit Tuesday morning, slightly softer than expected overall, but not to me. What I do is I follow personal incomes from my analysis as an economist first and foremost. Personal incomes, the rate of growth drives the rate of consumption within the economy. This is the biggest portion of the economy, individuals within the economy versus, say, business and government. Now, business and government certainly contribute to the economy, but businesses respond to overall trends with the consumer. If the consumer is consuming more and more and more because the rate of growth of incomes is increasing more and more, businesses will respond. Governments tend to be fairly flatline. So when we see retail sales, you start with incomes, move to expenditures. All retail sales is an extension of personal expenditures. So following personal incomes, you pretty much know what retail sales is going to do. We didn't see much in the way of a movement on Tuesday. It was a fairly inside day for trading. Holiday shortened week, of course. Yesterday, Juneteenth. Nice to have a day off, of course. Moving forward, my expectation remains exactly the same at this point, given the information we have. Personal incomes have kind of moderated and moved slightly sideways below median. So we're going to see expenditures follow suit. We will see revenue growth rate for companies moderate and slow down. So let's kind of encapsulate everything. Here's a bigger look at, this is actually SPY stock itself, of course, pushing all-time highs. The economy is very strong despite what's going on, but a lot of this is really kind of a handful of just individual stocks. The rest of the stock market isn't really moving as much. These are just a few players that are really pushing things around. In the meantime, gross domestic product, GDP, is everything produced inside this country. GNP is everything all Americans produce. And from a trend line basis, we are well above trend since COVID. Now, the big sort of culprit for that is fuel. If a car needs to move, you need fuel. And who handles that? The Federal Reserve. Everybody's always pointing the finger at a president like, oh, the economy's so great. Oh, the economy's so terrible. It's the president's fault. The president has nothing to do with the economy. It's all about the fuel. And who handles that? Federal Reserve. And right now, as you can see, the M2 money supply skyrocketed because of COVID. The Federal Reserve dumped cash all over the place. We're paying the price for it in inflation, housing, prices for everything, food, everything across the board. But what is the Federal Reserve doing at this point? They're slowing the growth of that down. So that's something to kind of keep in mind. Here is a third chart. This is, of course, SPY stock, or actually I used US 30, the Dow. When you put this together, you can see that GDP and the US 30, the Dow, are moving fairly hand in hand. And if you look at what's happening with the money supply, we're likely to see a correction move back toward trend line with GDP and, of course, the stock market. I'm not saying recession. I'm saying a shift back to trend line. We're highly accelerated at this point. So if consumption by individuals starts to slow down, so will revenues, so will stock prices, along with GDP and other things. Here's another look. This is GDP versus US CPI. Consumer Price Index, of course, has moved hand in hand with GDP. When you look at this chart, you can say, yeah, I can actually visually see all the inflation. Everything across the board, prices are up. Companies are bringing in all that extra revenue, but the Federal Reserve is shifting this away. We're going to go back to trend line. Sure, these all-time highs, I made some money on Monday. I kind of got real close to break even on Tuesday. Monday was an awesome day. Tuesday was fairly flat going into a 3-day weekend. Today and tomorrow, because of triple witching hour, we'll probably see a lot of volatility, up, down, sideways. But we also saw NVIDIA spiking higher. That seems to be easing back, and the stock market's following suit from that. But if the Federal Reserve shifts inflation, the money supply, you'll see a shift in GDP to trend line. We're way out of line with trend line. And that's something that's so important to encapsulate when you're looking at this, is asking the question, how much further is this market going to go? It's going to keep going until the stock market really grasps onto the fact that the economy is slowing. Notwithstanding, we have several companies that are just flying. And that's really kind of the balancing act, sitting there saying, well, the economy is beginning the process, which we just saw on Tuesday with retail sales, of slowing down, moderating, becoming more moderate because of what the Federal Reserve's doing. At the same time, NVIDIA is on fire and is pulling other stocks up. So this is the balancing act. My take on AI stocks is, you know what, NVIDIA, they're going to be the kings for some period of time, simply because the architecture needs to be built up front and they have the best products out there. Other companies are going to catch up. They have no choice. And because of that, the pace of NVIDIA will probably moderate. Other companies will start to catch up. But the second thing is, that's just the architecture, the hardware. The services is where the real profits are going to be, but it's probably going to take some time. So we'll probably see a balancing of all those high-flying stocks to more moderation. And I expect a lot of this to happen September, October, November, December. I've been saying this for over a year now that, yeah, we're going to see a stock market that continues to move higher and higher, especially all through summer. But in the fall, that's when I see SPX really taking a hit. So this is how I'm kind of looking at things. As I look at this GDP versus inflation versus the stock market, when you start putting all these three things together, we will see this moderating as the Federal Reserve contains the money supply. That's the fuel that drives this economy. And since they're constricting the money supply, the economy will respond. Make sure to hit that like and follow button. I'll keep you up to date on my thoughts on what happens next with SPX and the other stocks. We'll see you in the next video.